All right, good evening. It's Ashley Murphy from Arete Wealth Strategists Australia here. Thank you for joining me for tonight's very important webinar to do with covered expatriates and the Heart Act. Before we get going here, let me just briefly check that you can in fact hear me and see me here. It's always a little unnerving as you don't know if you're being heard or not. So let me just quickly confirm that with my paraplanner who is joining me here tonight. Thank you, Kellen. Let me just chat very quickly. Yes, excellent. People can hear and see me. Wonderful. Well, let me continue then with the presentation. So, no presentation from a financial advisor is, of course, complete without including disclosures. This is for educational purposes only. You would be ill-advised to act on what we talk about here without seeking professional guidance. This is an educational nature and doesn't constitute financial advice. So a quick background about who I am. I'm a tri-citizen of the United States, Australia, and the UK. I was raised in Brisbane, Australia, moved to the US in 2005, worked in corporate finance for a number of large companies for a couple of years before I saw the light and got into financial planning. I came into an inheritance myself when a family member passed away, went around looking for a financial advisor. And in Australia at that time, I found that there was an absence of real professionals that knew a great deal about their craft and who had a fiduciary obligation, that is, a professional obligation to serve my best interests. And that lit a spark for me that there was an opportunity to act in that capacity, and that's what drew me to it. I moved into the field. I started the CFP in 2008, had great success, won a number of scholarships in the San Francisco Bay Area where I was living at the time. Let me see, I started towards the CFA designation, did not complete that, but learned a great deal, and I was an instructor at UC Berkeley Extension and Golden Gate. So Arete Wealth Group is the firm I own. It has two brands, Arete Wealth Strategists Australia and Arete Wealth Strategists, where we obviously, in the Australia side, we focus on Aussie expats in the United States. We're the only firm, to my knowledge, that is focusing exclusively on Aussie expats in the United States. And on the Arete Wealth Strategist side, we work with business owners and executives. So if you happen to be an Aussie business owner or executive, then you're especially well served with our services and advice. So we're essentially, what role do we perform as a financial advisor? We're the general financial contractor. Maybe a better analogy would be we're the quarterback, where I feel my firm, we've got great knowledge and resources and experience in this area, but no one knows everything. And we have spent the last 5 years developing these networks to be able to make appropriate referrals when the situation calls for it. So there's different types of Aussie expats. There's really three varieties that I see, and that is the folks that are here for a working holiday or a defined period of time, and they have particular needs. They might be well served by certain firms that I work with in Australia and can make a referral to. Given that their US advice needs are going to be pretty limited, seeing as they're not really going to be domiciled here in the US. There's the domicile uncertain. These are the folks that maybe have a very good job here, but they're waiting for that final decision before they're going to stay, be it meeting Mr. or Mrs. Right, or getting offered that job, or whatever the circumstances are. And then there's the group that we primarily work with, and that's the permanent movers. Those are the folks that have come here, that made the decision that the United States is right for them for whatever reason. And so their advice needs tend to be a little bit more involved and complicated. There are two service tiers that we have. Tier one would be an advice-only engagement, and we work with clients on a subscription basis for a minimum of a 12-month period. And tier two would be our premium service offering. That's Wealth Fusion is what we call that. That's where we're performing the investment management and providing all that same advice. Okay, so an outline for tonight's presentation. What is the Heart Act? who is affected by it, when and how do you become a covered expatriate, what is the exit tax and how is it calculated, strategies for avoiding and minimizing the exit tax. So what is the HART Act? Let's get into it, shall we? What is the HART Act? The HART Act, Internal Revenue Code Section 877A, was passed on June 17th, 2008. And what it did was introduce a number of new tax laws effective for expatriates. So let's take a look at what those were. It was primarily intended to stop US persons from expatriating for tax reasons. And we can see it affects a group of individuals known as covered expatriates, which we'll define on the next slide. But here are the three changes that are brought into effect. A deemed disposition or exit tax, that's really the focus of tonight's presentation, but two other taxes that are brought in, a gift and estate tax and an inheritance tax applicable to US beneficiaries receiving assets from certain expatriates or their estates. It's at this point, it's worth noting a couple core concepts when we're talking about tax. And these concepts would include legal residency versus tax residency and source of income. So legal residency, that refers to, say, whether you're a dual citizen here or whether you're a green card holder or you're on a visa. That's your legal status, your legal residency. There's also tax residency, which is a different concept. And tax residency, say in Australia, if you live there for a certain period of time, certainly if it's your domicile, if it's your intended long-term country of residence, as demonstrated through a whole host of various facts, but say owning real estate and having your being registered to vote, which of course is mandatory, I know, and spending a certain period of time there per tax year is going to deem you a resident of Australia. And if you're a resident, if you're physically resident in Australia, without getting too technical, you're also a tax resident. Now, this is where sometimes people can get a little confused with what accountants might say. They'd say, well, Australia has a global tax system too. Technically, that's correct. Yes, it does. But here's the kicker. Only when you're resident in Australia are you a tax resident. The United States is different in this regard. It's alone, other than Eritrea, it's alone in being the only country whereby if you are a US resident, you are always a US tax resident. Thus, if you're a dual citizen, green card holder, then, or you've happened to satisfy the US residency test in a certain year while being a visa holder, but those situations are far rarer, and we're not talking about that tonight, but we're focusing specifically on dual citizens and green card holders. If you are either one of those two, then you are always a US tax resident, and the IRS is always interested in assessing the appropriate global tax. Now, that tax might not be that much given tax treaties and various credits and offsets, but the important thing is that they want to know about it, and that can be, it can be two things. It can be complicated and expensive for you, both in terms of administration, filing the appropriate paperwork, and of course, in differences in tax, in certain things that might not have been taxed. Please see my prior webinar to do with superannuation and how being a US tax resident affects that. The other concept here is source of income. Source of income. So if you're not resident in Australia, i.e. you're living in the United States, but you have what's referred to as Australian sourced income, namely real estate, an Australian business, or you are the beneficiary of an Australian trust, then the ATO is going to be interested in hearing from you in the form of a tax return. So let me continue here. Who is affected by the HART Act? Well, certain taxpayers can more easily renounce their citizenship or US resident status, while others, known as covered expatriates, as we'll talk about here tonight, face more stringent and expensive tax consequences. The renunciation of citizenship or the surrendering of a green card can subject the individual to the so-called covered expatriate rules, which include a deemed disposition tax that we'll talk about in more detail that can cause the individual's entire net worth globally to become immediately taxable upon leaving, including triggering all unrealized capital gains and the instant deemed liquidation of all IRAs. Not very happy, Jan. Specifically, green card holders who relinquish their green card after spending 8 of any of the past 15 years in the US who satisfy any of the following 3 tests. Let's walk through these 3 tests. You're considered a covered expat if after June 1708, you're at, now this is, let's just slow down and go through this. If your average annual federal net income tax, that's not income, because it's a relatively low number, $165,000 tax. So in other words, you need to be making a whole lot more than that, several hundred thousand, maybe $500,000 before you're likely to be hit with an $165,000 tax. But remember, that's an average tax bill over a 5-year period as well. It may also be that a high-income earner who has a number of exclusions and deductions and so forth may be able to bring their tax below that level and thus avoid that particular test. But there are, of course, other tests. Next one, that this is a real stickler, particularly given that this is not indexed for inflation, unlike those other numbers. The 165 in the previous example of the income tax test. So if you have a net worth, and we're talking global net worth, what's in your family trust back in Australia counts. What's in your superannuation account counts. On the date of expatriation or termination of residency, then you trigger the test. Keep in mind, as I'll talk about on the next slide, community or joint property is not recognized, which is extra bad news. Then the third test is kind of a catch-all. If you fail to certify on Form 8854, Form 8854 is the form you file to notify the IRS that you are no longer a tax resident of the US, that you have complied with all US federal tax obligations for the 5 years preceding expatriation or termination of residency. Note, lack of full and accurate compliance or failure to certify such compliance results in automatic designation as a covered expat, even when other exemptions otherwise might apply. This is important. So 2 things important to note here. The clock starts from when you become a green card, not from when you entered the country. So if you were on a visa and then became a green card holder, it starts from when you became a green card holder. It starts from exactly when you became a green card holder. Sorry, the year of that you became a green card holder. Now, if you're in the US on a visa and have been for some time, you don't need to worry about the Hart Act. Does not apply to you. I threw this slide in here because it's in other source materials that I referenced in putting together this presentation. I feel they underplayed this point, but it is supremely important. Married couples. So the married couples need to be aware that the Form 8854 has no joint filing status. What that means is that everyone that completes that form, which is every individual that expatriates, is declaring their entire global estate as an individual. So that will really impact, particularly to do with the net worth and income tax liability test. So net worth test, assets that are held in joint title or in community property states, you are deemed to have your full, according to the state laws in that applicable state, but you are deemed to have full ownership of those assets. Please, yet again, consult counsel on this before screaming or pulling your hair out, given that, that this could catch a whole lot more individuals. The average tax liability test. So remember, if one spouse was a non-working spouse, the other was an extremely high income earning spouse, you file your taxes jointly. Your average income tax for the past 5 years being higher than 165,000 may subject you, even though you had no earned income at all. We'll talk towards the end of the presentation about strategies as to how one might avoid that. Certain exceptions apply. We can go through this quite quickly. Individuals relinquishing citizenship before the age of 18 and a half. I don't know why they said 18 and a half, but they did. If the individual is a resident for no more than 10 of those tax years before such relinquishment. So pretty narrow exception there. And dual citizens, provided they haven't lived in the country for 10 of the past 15 tax years. Tax consequences of expatriation. Okay, this is where we should really spend a bit of time to be quite thorough. So, what they apply is a mark-to-market approach. That is to say, the fair market value of your assets on the date of your departure is what is used for assessing capital gains and the values of your IRAs at their deemed disposition. This will be the date at which disposition is deemed to have occurred. So I would explain this in saying the simplest way to think about it is as if you died. And this is, by the way, the tax principle under which this all came about is equity to US persons that remain US tax residents, and that was the principle there, the jurisprudence that behind that. So if you were to die and you're a US tax resident, remember the US has a global purview of your assets. Thus, if you're expatriate, they have a global purview of your assets. Keep in mind, second point here, disposition rules stipulate that all deemed income retains its original character, which means that long-term capital gain property will be taxed at long-term gain rates. Short-term property, short-term rates, ordinary gains at ordinary income, ordinary income or ordinary gains, such as in IRAs, would be taxed at ordinary income tax rates. So it's important to note, as you see here on the second bullet point, the first $713,000 for 2018, that is another one of these items that is indexed annually. The first 713 in gains is exempt from this tax. So at least there's a little bit of an exclusion there. And this doesn't apply against income from the deemed distribution of IRAs, given that, as you heard me say a moment ago, that is deemed ordinary income and all assets retain their tax character. Okay, thankfully, looking at the third bullet point here, thankfully IRAs do not incur the early penalty, but it's as if all that income is recognized immediately. Assuming you're carrying forward significant losses, you cannot make money from this. That would be a pretty rare circumstance, but that's not possible to do that. And an important exception to the deemed disposition rules it applies to 401ks and non-qualified deferred comp accounts, where they are not taxed. They are not deemed liquidated, and their taxation gets a whole lot more complicated, given that we have to look at the tax treaty. Refer to my prior webinar on 401ks and how they're reported and taxed back to Australia. Keep in mind, the current maximum capital gains tax is 23.8%. For higher income earners, that's 600,000. If you're making 600,000 on an AGI basis, that would put you into that 23.8%, which includes the net investment income tax. Taxpayers below that level are going to be taxed 15% federal and an applicable state tax, should there be one. Now, we need to be mindful of, and we'll talk about this on the final slide to do with strategies, but it's important to note that much as the same applies with estate tax and death, as you heard me say at the top of this particular slide, the first bullet point here. there is a 3-year clawback. So gifts given in the prior 3 years will be clawed right back into the calculable estate. Let's keep going here. So relinquishment of citizenship. Presumably you'll be able to see that on the screen. A kind viewer notified me that there was some pixelation in a prior upload, so I will confirm I'll re-upload that presentation, and I'll confirm that that doesn't affect us right here. But the important thing to note here is expatriation is permanent and irrevocable. And after doing so, the taxpayer would be treated, with important exceptions noted, as a non-resident alien. That's not to say that you wouldn't be able to re-enter the United States. There is, let me say for full disclosure, there is the Reed Act, which has not been enforceable to my knowledge to date. Yet again, this is for your personal educational purposes, not to be relied upon for your actions. But the Reed Act says that you would not be able to enter if your renunciation was deemed to be for tax reasons. However, that has not been enforced, and some have said it's unenforceable the way it's written. So I'm just making you aware that that exists, so you can do your own research and satisfy yourself. But nevertheless, for those that I have spoken to that have done this, they have been able to re-enter the US and there haven't been any major problems. But nevertheless, I was saying the act of renunciation must take place before a US diplomatic or consular office outside the US. Otherwise, you risk becoming a stateless individual. Next, relinquishment of green card. Similar thing. The details here are on the screen. Please feel free to pause the presentation to read through that. So getting to the gist of the planning strategies here, I'm going to go through 2 pages of general planning strategies one might employ if they're concerned about becoming a covered expatriate. So given the relatively low $713,000 capital gains tax and 3-year clawback provisions, you might want to start thinking about this years ahead. So what are some of these strategies? Well, first strategy might be gifting. Thankfully, there are some pretty generous gifting exemptions in the US. Thanks to the Tax Cuts and Jobs Act of 2018, there are 2 relevant exemptions. First one I don't think is even all that relevant, $15,000 annual exclusion. Well, that's not much if we're talking about having to really move the numbers in our estate. The next one is the unified lifetime credit, and that for an individual is up to a little over $11 million. That's what you may give away in your lifetime before you begin incurring gift tax. Gift tax is incurred at 40% above that 11 point, I believe it's 11.3 million in 2019, but please check with our tax key financial data sheet, which you can find at Arete Wealth Strategists Australia. Under the media tab, we've got what I believe to be the only key financial data sheet that includes both Australian and American data on there. So take a look at that. 11.3 approximately in 2019. Above that, you're getting hit at 40%. That's the gift tax. So you've got a pretty generous lifetime exclusion amount right there that you might choose to make to family members or other loved ones. Let's get into some more advanced strategies. Discounted valuation techniques, something like a family limited partnership. There isn't the time or scope in tonight's presentation to talk about what that implies, but there are ways of gifting assets and having discounts applied to the value of that asset given certain attributes about its new character. Next, and a favorite of higher net worth individuals would be an irrevocable trust, where you're able to keep assets in the United States as a non-resident alien and still obtain very favorable, in fact, better in many cases than US persons, tax treatment on those assets. Now keep in mind, there may be some more sophisticated trust and estate planning work involved with that to avoid getting hit on the other end when the trust matures and potentially estate taxes apply, where the estate tax treatment for non-residents is anything but equal. Not good. Tax planning strategies would include a basis reset on on low basis capital gain holdings. What's a basis reset? It may be a year for whatever reason. Maybe that bonus doesn't come through that pushes you above into hitting that 165 federal average 5-year band that we spoke about earlier. And you may choose to pay the tax on certain low basis positions in order to pay the tax at a lower level, so that while it may be included in your estate when you exit, at least you're not paying it at 23.8%. That's the idea here. You may also, in a similar vein, in the year of expatriation, seek to do that towards the beginning of the year, or keep your income lower in that year to save on that difference between 15 and 23.8%. For the case of the income tax test, if you feel you're going to fail that one as opposed to the tax compliance or the asset test, then you may consider married filing separately. Very rarely in my career have I recommended married filing separately. It's a loophole that the IRS cracked down on years ago, and the rates are punitive. So individuals, or I should say couples, seeking to employ a married filing separate strategy to avoid becoming covered expatriates would be doing very sophisticated tax planning to avoid, or I should say to realize that in the years preceding their departure, they're doing that with the full knowledge that they're paying a higher tax now to avoid paying an even higher tax at their departure and being deemed a covered expatriate. Another idea prior to the year of departure would be to sell your primary residence to take advantage of that exemption that's given. $250,000 in capital gains for individuals, $500,000 on your primary residence for those married filing joint, because no credit is given in the year of departure for that. So otherwise your entire primary residence would be subject to a capital gain. You may also consider the idea of a reverse rollover of an IRA. More commonly, folks are moving IRAs, 401ks to IRAs. In this strategy, given the difference in tax treatment, individuals may choose to move their IRAs into their 401ks if they're contemplating expatriation. Do keep in mind the world of cross-border financial planning is extremely complicated. If you work with a domestic advisor, they may be out of operating out of their area of expertise, doing what lawyers refer to as door law, that is, providing law based on anything that walks through the door, and not realizing that the world of cross-border planning is extremely specialized, requiring knowledge of tax treaties, state tax treaties, totalization agreements, and other advanced strategies to do with moving 401ks, recontribution strategies in Australia to get that back into a superannuation account at the lowest, with the lowest tax impact. So just be mindful of that. More planning strategies, consider charitable gift strategies. First one of which is you have to be charitably inclined in the first place to consider this, but you might consider a donor advised fund to get your, for the case of the asset test, to get your asset level below there. Or another strategy might be a charitable remainder trust. This is a strategy that I absolutely love, given that I am a believer in supporting the charities, and I do encourage clients that are inclined in that direction to consider this one. Essentially, it's a more complicated strategy that I'll do a webinar on at another time. Immigration planning, this is pretty straightforward, really. Stay on, if you think you might return overseas, then consider staying on your visa as long as possible and not becoming a green card holder or citizen in the first place, and thus subjecting yourself voluntarily to the possibility of being deemed a covered expatriate. So that really concludes the content for the tonight's presentation, but I did want to show you some technology that we're very proud to be able to offer, and the only advisor, as you've heard me say, working with Aussie expats, to my knowledge, that has such an offering. You can see here we use a program, an institutional portfolio reporting program that allows us to report in both US dollars and Australian dollars. So you can see up here, this portfolio snapshot is recorded in US dollars, and then look over here in Australian dollars, with the ability to drill down into individual holdings that are held on the Australian Stock Exchange or in Australia. Some downloads you might be interested in taking a look at would include our key financial data sheet for 2018-19. For Aussie expats, go to arete-wa.com, media tab, and you'll find it there. And we've also got some white papers. I promise you they're coming out this year, more to come. But we do have one up on how your Aussie property be taxed now that you're a US tax resident. And that's changing all the time, particularly given a ruling late last year about the primary residence exemption not applying to non-resident property owners. So that concludes tonight's presentation. Thank you very much for joining me here. I've got upcoming travel to visit clients in San Francisco, and I'll be in Brisbane for a month, possibly visiting other cities in Australia, but that's all that's on the books presently. Thank you very much for attending tonight's presentation. If you're interested in scheduling a time to see if you might be a suitable client for my firm, then I'd encourage you to go to our website and complete our contact form, schedule a 15-minute phone call, 15-minute fit meeting, and we'll speak. Thanks so much, and best wishes to you.